So, good evening, everyone. Welcome to the first class of June session. Now, before I start teaching, I want to give a couple ground rules. So, first of all, we're all here to learn. If you understand, no one should act like they know everything already, because if you know everything already, you're not going to be here. So we're all here to learn. And secondly, it's going to be 4 sessions. So we have the first session talking about market structure, introducing liquidity, and then one point of interest. After that, we have another session, which is on the other point of interest we make use of, and how to pick your point of interest, like the rules in picking a proper point of interest. Now, after that, there's also another class that's different types of liquidity and how to take your profit on those types of liquidity. Then we also have the class on directional bias. So, this, can you guys hear me? Can you guys hear me? Can you hear me? Okay. So now the strategy that I trade, what I trade revolves around three key things. Now I pay attention to three things specifically: market structure, liquidity, then point of interest. Market structure, liquidity, then point of interest. These are the three key things I pay attention to when I'm trading. Now, that is what the whole strategy revolves around. Although this is smart money concepts, but it's with my own logic behind it. So market structure, liquidity, point of interest. So these three things is what I fuse together to get my entries for my trades, to get my entry model and my trade model. So first of all, we'll talk about market structure, then we'll talk about liquidity, then we'll move to one point of interest. So I make use of 2 points of interest, but I'm going to only introduce one in this class. I may introduce the other one, but I will go deep into it in the next class. So now, first of all, we are going to talk about market structure and what market structure is. So market structure is basically the current movement of the market or the current flow of the market. That is what market structure is, the current flow of the market. That is what market structure is all about. The current movement of the market, the pattern that market uses to approach one point or the other. That is what market structure is. Now, there are three ways that market makes its movement under two categories. We have, first of all, we have the trending market, and secondly, we have the ranging market. So the three ways that market makes its movement, we have the uptrend, the downtrend, and then the ranging market. That is under market structure. The three ways that market makes its movement is either market is trending to the upside or market is trending to the downside. I'm already recording. You don't need to record this to your computer. So it's either market is trending to the upside or it's trending to the downside, or market is ranging. Now, by uptrend, this is what it means for market to be on an uptrend. We see market making a series of what? Higher highs, then higher lows. Higher highs, then higher lows. Higher highs, then higher lows. This is what an uptrend is made up of. Then for a downtrend, you see markets making a series of lower highs, then lower lows. Lower highs, then lower lows. Lower highs, then lower lows. Then if it's a ranging market, you see markets moving from point A to point B, from point B down to point A, from point A to point B. So it's basically from support to resistance, resistance to support, support to resistance, resistance to support, support to resistance, resistance to support. So these are the three ways that market makes its movement. Either it's on an uptrend, or it's on a downtrend, or is ranging. So these are the three ways that market makes its movement. So when market is moving from one point to another, it's either trending to the upside or to the downside or is ranging. So it's basically something like this. For example, this here is an uptrend. But market is moving to the upside. This is an uptrend. You can see market making what? Higher highs, higher lows, 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 higher highs, higher lows. So this is what? This is made up of what? A series of higher highs and higher lows, and this signifies what? An uptrend. Then this is made up of a series of lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, and this signifies what? A downtrend. So our market is on an uptrend, it's basically trending to the upside. Our market is on a downtrend, it's trending to the downside. And then when it's ranging, you call that range a consolidation. Basically, markets being accumulating liquidity before it moves to the direction it is intended to go to. So if market is ranging, it's not really going anywhere, it's just traveling at a fixed point. So I hope you guys are following me up so far. Okay, so now, like I said, the three ways that market makes its movement, either market is trending to the upside, or is trending to the downside, or is ranging. These are the only three ways that market makes its movement. So that is what basically the introduction to market structure. Now, there are ways that we now trade market structures. There are two key things we pay attention to when we're looking for the market structure part of the strategy. Now, the first one we pay attention to is either you are looking to join a continuation for the trend, or you are looking to join a reversal of the trend. These two things, either you're looking for a way to join into the trend, or you're looking for a way to join into the reverse of the trend. So what I mean by continuation is, if market is on an uptrend, what you're going to be looking for, if it's for continuations, is a way to join into the buy of the uptrend. Then if market presents you an opportunity for a reversal, then that is the reversal part of it. So it's only two things that you are looking for when it's coming to market. When it comes to market structure, you're paying attention to only two things. Are you looking for a way to join into the continuation of the trend, or are you looking for a way to join into the reversal of the trend? Only these two things. So if it's a continuation, if it's an uptrend, you're looking for a way to jump into market being on the uptrend. But if it's a reversal, if it's an uptrend, you're looking for a way to join into market setting to the downside. And if it's a downtrend and you're looking for continuations, you're looking for a way to join into the what? The sell. But if it's a downtrend and there's a reversal, you're looking for a way to join into what? The buy. So there's only two things you pay attention to when you're trading market structure. Either you're trading continuations or you're trading reversals. Now, the two phenomena that we use to trade reversals and continuations, the one for reversal is what you call a market structure shift. What we use to trade market reversals is what you call a market structure shift. So market structure shift is basically an indication that the current trend the market is on is ending and the new one is about to begin in the opposite direction. So market structure shift That is what market structure shift is. So market structure shift is an indication that the current trend is about to end and the new one is about to begin in the opposite direction. So this is just a theoretical definition. When it comes to practicalizing it, what this means is that if market is on a particular trend, any deviation from the characteristics of that trend means that a market structure shift is occurring. So now we have a basic uptrend, and the basic uptrend is made up of market making a series of what? Higher highs then higher lows, higher highs, then higher lows, higher highs, then higher lows. So we already know that the characteristics of an uptrend is what? Higher highs and then higher lows, higher highs and then higher lows. But if markets should deviate from making higher highs and instead of making a new higher low, it takes out the last low and makes what? A lower low. Then this means that a market structure shift just occurred here. If market deviates from the normal pattern of any trend is on, then that means that a market structure just occurred. So it's just like, let's say we have a downtrend, you have lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. So the pattern of a downtrend is made up of what? Lower highs and lower lows. It means that if markets should deviate from making lower highs and lower lows, it means that market is no longer on a downtrend, but is now shifting structure to the upside. So if market continues this downtrend, lower highs, lower lows, lower highs, lower lows, and it comes, instead of making another lower high to now continue the lower low, it takes out the last high here. This means that a market structure shift just occurred. And once a market structure shift occurs, it means that the current trend that market is on has ended, and the market is now planning to reverse to the opposite side. So if you had a previous uptrend and the market structure shift occurs, it means that they are now preparing to take this trade to the downside. And if you had a previous downtrend and the market structure shift occurs, it means they're now looking to take this trade to the upside. So that is what market structure shift is used for. It's used for reversals. Are you guys following me up? Yeah. So, like I said, when you're trading market structure, the only two things you're paying attention to is either to join a reversal or a continuation, but you can only join in with the one that market presents to you. Do you understand? So now it means that if I had a previous uptrend and I happen to see something like this occur, this market structure shift, it means I'm now preparing to take what? A sell. And if I had a previous downtrend and I see a market structure shift occur, it means I'm now preparing to take what? A buy. So this gold here, there was a trade I caught on gold here, and I'm going to show you guys exactly how I caught the trade. So I'm going to be using this as the example. So I had a previous uptrend here. So I had a previous uptrend, and then that's market being on an uptrend, making a series of higher highs and higher lows. So the whole uptrend continued, making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So this was what the uptrend was made up of. You can see it: higher highs, higher lows, higher highs, higher lows, higher highs. So the whole trend continued. So this was the last high, this was the last low. Market now made a higher high again. Instead of continuing to make another higher low to push up, what did it do? It took out the last low here. So what this means is what? A market structure shift occurrence. So we had a previous uptrend. Then instead of market to continue that uptrend by making higher highs and higher lows, it broke the uptrend and took out the last existing low. So what this means is that a market structure shift just occurred. So I'll mark an MSS here. So since we had a previous uptrend and the market structure shift occurs, which direction are we now looking to trade? If you have a previous uptrend and the market structure shift occurs, which direction are you now looking to trade? Exactly, down. So as we have a previous uptrend and market gives you a market structure shift to the downside, what it means is that that previous uptrend is now shifting to the what? To the downside. Same as if you had a previous downtrend and the market structure shift occurs, it means that downtrend is now shifting to the what? To the upside. So here in this situation here, we have a previous A previous downtrend here. You can see markets making lower highs, lower lows, lower highs. So this is what? Lower highs, lower lows. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then price came here and then took out this high. So when it took out this high, this is what? A market structure shift. So as market was in the previous downtrend and the market shift occurs, what are you now looking for? Which direction are you now looking to trade in? If market was in the previous downtrend and you get a market structure shift to the upside, then what are you now looking for? You're looking for buys. So market structure shift is for trading reversals in the market. That is what market structure is. If you are on a previous downtrend and all of a sudden you get a market structure to the upside, it means that downtrend is now going to change to an uptrend trade. And if you are on a previous uptrend and you get a market structure to the downside, it means that previous uptrend is now changing toward a downtrend. But like I said, when you're looking for the structure part of the strategy, you're looking for only two things. Either you're looking for a way to join the reversal or you're looking for a way to join the continuation. So this is the real chart example of a market structure shift here for the downside. And then this one up here is the one for when it's on an uptrend and you get a structure shift to the downside. This one is the one for when it's on a downtrend and you get a structure shift towards the upside. So I gave the real chart example here. So now, after that, so that is the one for trading what you call reversals. Now, aside that, there's also a strategy that we also use in trading continuations. For example, you know that for reversals, you're only looking to reverse the trade. If you're on an uptrend, you're only looking to take a sell. If you're on a downtrend, you're only looking to take a buy. But what do you do when you're on an uptrend and you still want to continue taking buys in that uptrend? And you're in a downtrend, you're still looking for what to take sales to the downside. That is what you trade, what you call a break of structure. A break of structure is basically a scenario where market keeps breaking key levels while maintaining its current trend. A market structure shift is an indication that the current trend is ending and a new one is about to begin in the opposite direction. But a break of structure is a scenario where market keeps breaking key levels while maintaining its current trend. So in structure shifts, you are trading opposite of the current trend, but in break of structure, you are trading in line with the current trend. So a break of structure is a scenario where price keeps breaking key levels while maintaining its current trend. Are you guys following me up? Are you guys following me up? Okay, good. So the difference between a market structure shift and a break of structure is a market structure shift, once you get a market structure shift occurrence, you are trading opposite of the trend. But in break of structure, when market is giving you a break of structure, you are still going to be trading in line with the current trend that market is on. But it's going to keep breaking key levels. By key levels, I mean recent highs and lows in the market. But this is what I mean by key level. If you have an uptrend, a market makes a higher high and then makes a higher low, this last high in the market is now a key level. So when price comes here and breaks that last high, then this is what you call a break of structure here. So once a break of structure occurs, it's giving you an intuition that price is going to pull back again, and then the uptrend is going to continue. So once price pulls back to make a new higher low, this high in the market becomes a new key level. So it's expected for market to still go up again and then take out that high. And once it takes out that high, that's what you call a break of structure again. So markets will now pull back again and make a new higher low. Then this last high becomes a key level. Once price goes up and takes that high out, that's what you call a break of structure. So in break of structure, markets will maintain its current trend, but it will keep breaking key levels. So once price breaks any key level, can you guys hear me? Can you guys hear me? So once you're trading break of structures, you're trading in line with the current trend of the market. Can you guys hear me now? Can you hear me better? I think the network is back. Can you hear me now? Is my voice still breaking? Okay. So I should start with break of structure again. All right. So like I said, for break of structure is a scenario where price keeps breaking a key level while maintaining its current trend. So you already know the market is on an uptrend. So if market makes a higher high, let me come back again. If market makes a higher high, comes down to make a higher low, the last high in the market is what? A key level. The key level there is a resistance. If market goes up and takes out that high, then this is what you call a break of structure right here. The market comes down again, makes a new higher low. This last high in the market becomes what? Another key level. So market going to take out that high now is what? Another break of structure. Then price comes down again and makes a what? A new higher low. This last high in the market becomes another. This last high in the market becomes another what? Key level. Once price goes here and takes out this high, that is what you call another break of structure. So if you see markets on an uptrend and the break of structure is enabling markets to still continue being on the uptrend. So if it was a market structure shift, it would have reversed the trade to the downside. But for break of structure, it's giving you a way to still join into the buy because once it breaks a new structure, it's obviously going to retest and then go out to break a what? Another structure. But if it was a market structure shift, a structure shift will now come down and take out this last low here. And this is what a market structure shift is. But all these ones that kept breaking the high is what you call a break of structure. So when it comes to trading continuations, we pay attention to what? To market being on giving break of structures. But when it comes to trading reversals, we pay attention to market giving us what? Market structure shifts. Now, an example of break of structure is this. We have lower highs, we have lower lows. The market came back again to make another what? Another lower high. This last low in the market is what? A key level. So when price comes here and takes out that low, then this is what a break of structure is here. So this zone that market just took out, this low, is what your break of structure is. Then price will now give you another opportunity. So because that break of structure occurred, it will give you another opportunity to what? To take another sell. Then price goes down again, takes out this last existing low here. This is what? Another break of structure. See, so break of structure is markets being on a particular trend, but it's going to keep breaking key levels, but it's going to still maintain that trend that it was on before. That is what break of structure is. But when it comes to break of structures, I don't just trade regular break of structures. All these single break of structures, these higher highs, higher lows, then a break of structure, higher lows, then a break of structure, higher lows, then a break of. I don't pay attention to these ones because these are just what we call single break of structures. When market just keep breaking one singular break of structure, that's what you call a single break of structure. I don't pay attention to single break of structures. Why? Because they don't really give me enough space to look for entries and get in. So there's what we call a. Are you guys following me up? Okay. Then there's what we call a double break of structure. A double breakout structure is where market takes out two consecutive zones. Two consecutive zones. What I mean by two consecutive zones is there can be a previously existing resistance or a previously existing support. Let's say, for example, now, you know, there are always lows and highs in the market. So let's say, for example, now you had maybe markets on a previous down. Let's say it has something like this happen. The market did something like this, came up again, did something like this, then came up here, and then started being on a downtrend. So you see lower highs, you see lower lows. You see lower highs, you see lower lows. You see lower highs, you see lower lows. All these are single breakout structures because it's just taking down one consecutive zone. It's taking out one consecutive zone. So when market takes out just one zone, that is what you call a single breakout structure. So when this keeps happening, lower highs, lower lows, lower highs, lower lows. All these are what are single breakout structures. But once market now goes and makes what, let's say for example, it makes another lower high, it now takes out this low, while also taking out this previously existing support that was here. And that is what you call a double breakout structure. Because not only did it take out this low here, it also took out this previously existing support level here. So when market takes out two consecutive zones, that is what you call a double breakout structure. So when it comes to trading breakout structures, the ones I pay attention to are the ones that gives me a double breakout structure, not the single breakout structures. But when it comes to trading market structure shifts, once I see a single market structure shift, I take it. But when it comes to breakout structures, I try to see double breakout structures. That is when market takes out two consecutive zones, a previously existing zone, and then the recent zone in the market. Are you guys following me up? Okay, so what I say is I don't just pay attention to every single breakout structure. Like please don't draw on the screen, please. How to disable. If you don't want to do this, please delete this, please. So you're going to mess up the screen. So when it comes to breakout structures, there's a difference between a single breakout structure and a double breakout structure. In the market, there's going to be existing support zones or existing resistance levels before. So a market is on a downtrend and it keeps making lower highs and lower lows. Each lower low that it makes is a breakout structure to the downside, but those are single break. Of structures. Now, when market takes out two consecutive zones, that is taking out that low while also taking out a previously existing support before or a previously existing low, then that is what you call a double breakout structure. For example, here now on this chart here, we had what market on a downtrend, and while market was doing now as market was on a downtrend, we had these are our previously existing support zones. We have this support here. This is a support level. You guys can see if you know support and resistance, this is what a support level. So our market was making lower highs, lower lows, lower highs, lower lows, lower highs. Then it took out this low. Then it also took out this previously existing support level here. This is what you will now call a double breakout structure. When market takes out two consecutive zones, that is what you call a double breakout structure. But when it was taking down just this one zone, you can see lower high, when he took this one out, this is just a single break of structure. He went up here, took out this low here. This is also a single break of structure. But when he went up here, took out this low, by also taking out this previously existing support, this is what you now call a double break of structure. When market takes out two consecutive zones, that's the one I pay attention to, because that is giving me more confirmation that enough buyers or sellers are on the market. Are you guys following me up now? So when market takes out two consecutive zones, that is what you call a double break of structure. I think let me also see if I will get an example of this here. Here. So the ones I pay attention to trading is double break of structures. So when market was on a downtrend here, lower highs, lower lows, look, there was a previously existing what? A previously existing support level here, and also this previously existing low here. So when market took out this recent low, while also taking out this previously existing low here, this is what you call a double break of structure. So when it takes out, see, it took out, it sold and then took out this low, but it also took out a previously existing low here also. That is what you call a double break of structure. Same as this, took out this low, but there was also a previously existing low here. So it took out this and then this. So this is what you also call a double break of structure. So a double break of structure is the one that takes out two consecutive zones in the market, takes out two consecutive zones in the market, not just a single zone. If market is making, for example, if it's making lower highs, lower lows, lower highs, it's not taking out two consecutive zones, then that's just a single break of structure. But when it takes out two consecutive zones, then that's when you can call it a double break of structure. So when it comes to trading continuations, I don't just trade every single break of structure I see. I pay attention to getting what you call a double break of structure. Hope you guys understand me now. A buy scenario. Someone said I should give a buy scenario. Okay. Okay, this is an example of this on a buy scenario. Can see a previous uptrend, higher highs, higher lows, higher highs. The markets came here. This was the last high in the markets. But there was also a previously existing resistance level here. All these are resistance zones, but the last one you can see is here. This previously existing resistance here. So the market took out this recent high. It also took out this previous existing resistance here. This is what you call a double break of structure. So the market took out this recent high here. There's a recent, I don't know if you guys can see it properly. There's a recent high here. I'm trying to. There's a recent high here. This is the high, the last high in the market, the higher high here. Then there's a previously existing resistance level here. All this resistance here. So when market took out this high, while also taking out this high, this is what you call a double break of structure. When market uses a double break of structure, it means that if it's to the upside, it means that the buyers are a lot more in this market because it took out two consecutive zones. And if it's to the downside, it means that the sellers are a lot more because it took out two consecutive zones also. So this is this scenario for the buy side. When it takes out two consecutive zones, then those are the ones I pay attention to. Hope you guys understand now. Hang on, I'm still coming. Someone asking me when do you enter by yourself? Hang on, I'm just giving you guys. I'm still at the structure part of the strategy. I've not entered liquidity first. So now this is basically what makes up the market structure part of the strategy. Either you look for a continuation or you look for reversal. If you're trading continuations, you are looking for double. Listen, when it comes to break of structure, not every break of structure that I trade, I pay attention that I see a double break of structure. So we are looking for continuations, you look for a double break of structure. we are looking for reversals, we look for what? A market structure shift. You won't be the one to force market to give you that. Market will present itself, then you trade whatever market gives you. So if market gives you a market structure shift, it means that you are trading opposite of the formal trend of the market. But if it gives you a double breakout structure, you are trading in line with the current trend, or you're trading in that same direction that the market was traveling at before. So after getting your structure part of the strategy, the next thing that we'll look out for is the liquidity part of the strategy. Now, there are different types of liquidity in the market, but the one we use in picking entries, the liquidity that we look for immediately after we see our market structure shifts or our double breakout structure, the liquidity that we pay attention to looking for is what? Our inducement liquidity. This person asking this, I've not gotten to directional bias. You guys should wait. So like I said, after your market structure part of the strategy, you move on to the next part of the strategy, which is what? The liquidity part of the strategy. The liquidity part of the strategy is what? Different types of liquidity in the market, but the one we use in picking entries is what you call an inducement liquidity. Now, inducement is basically, hang on. Hang on, I'm coming. Are you guys following me up? Can you guys hear me? So the inducement is the first pullback that market makes after a market structure shifts or a break off or a double breakout structure. That is what the inducement is, the pullback that market makes after the market structure shifts or the breakout structure. Now, when we're looking for this is what I mean. So if we have, we only look for an inducement after you've seen a market structure shift or a double breakout structure. This is what I mean. If you have an uptrend, market is trending to the upside and is making higher highs, then higher lows, higher highs, then higher lows, higher highs, then higher lows. Then it makes a higher high, then instead of making another higher low, it takes out the previously existing low. This means that a market structure shift just occurred. Now, if you get your MSS, you've gotten the first part of the strategy, which is what? The market structure part of the strategy. So after that, you now look for the next part of the strategy, which is what? The liquidity part of the strategy. Now, I said the liquidity that we use after the structure part is what? The inducement. And the inducement is the first pullback that market makes after the structure shift or the breakout structure before it continues going to a direction where it shifted structure into. So after market does this market structure shift, I'm expecting market to give me what? A pullback to the what? To the upside before it continues pushing back down. So this pullback that market gives me is what my inducement is. Are you guys following me up? Like I said, there are different types of liquidity in the market, but the liquidity that I pay attention to for picking entries is the inducement liquidity. And the inducement liquidity is the first pullback that market makes after a market structure shift or the double breakout structure. So now, if you have a previous uptrend and market gives you a market structure shift to the downside, after that, I'm expecting market to make some sort of retracement. If it was a structure shift to the downside, it will make a retracement to the upside before it continues pushing back down. That candle, that retracement that market just made is what my inducement is. The inducement is a trap in the market. It's basically a trap that markets will eventually come back and take out before it triggers your main point of interest. So That is what your inducement is, the pullback that market makes after the break of structure or the market structure. So in this scenario here, market was on a previous uptrend. Eventually, price took out what the last low. That was when a market structure shift occurred. After that, market now did what? Gave me what? A pullback to the upside. After this pullback, this is what the inducement is. This pullback that market gave here, and after market gave that pullback, it's now continued pushing what? Back to the downside. So this pullback is what your inducement is. So the pullback can be a single candle. It can be multiple candles. It all depends on the volatility of the market at that given moment. So let me also find this. So as long as the market has given you a structure shift, the candle that pulls back is what your inducement is. So in this scenario here, same thing. So a previous downtrend, then price took out, wait, lower high, lower low. Okay, it's not really clear here, but let me use the one that's clear here. So after market gave us an MSS, it gave us what? Our pullback, which is our inducement, before it continued pushing back down. So that is what your inducement is. It also works for double break of structure scenarios. In this scenario, when price gave us what? A double break of structure here, another double break of structure, market made a pullback. After this candle closed, it made a pullback, which is this candle wick. That was the pullback. This candle wick is what our inducement is. So it can be a week, it can be multiple candles, depending on how market was reacting at the moment. But this is what our inducement is. It's following me up. We don't look for inducement before a double break of structure. Any inducement you see before that double break of structure is not the proper one that you're paying attention to. If market gives you an inducement before an MSS or a double break of structure, don't pay attention to them. You should only be looking for inducement after you've gotten the structure part of your strategy, not before you've gotten the structure part of your strategy. The inducement should only be given to you after you've gotten the structure part of your strategy. So are you guys following me up? If your inducement is multiple candles, just pick one candle there and draw it out. You don't have, will you pick up all the candles? You cannot draw out all your candles. You just have to pick one candle there, the one that is most visible, and then you draw it out. And yes. Hang on. So So in this scenario, there are multiple candles. You can just pick out one as long as it can be the last candle, it can be this last candle before market continue pushing to the downside, or you can still pick this first candle here, anyone, but it's still the same thing. So you just have to make yours neat. So once you pick out your inducement, you've gotten the second part of the strategy. Can you guys hear me? Okay, so let's give me to give another example. Market gave you a double breakout structure here. After this double breakout structure, this was officially when market gave you that double breakout structure. When it's used, remember, if market is going to give you